All right, welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, founder and CEO of Shepherd Wealth Management. Here at the closing week of January, getting ready to turn over into February, so almost 1 month down for 2023. And I'm very excited about today's show. Got a lot to talk about today for those that are watching for the first time. The whole reason why we do this show is to let you know what's going on in the markets in the here and now, so current events. But we also give a little historical context of what history has to say about similar events. Therefore, we can start to make some intelligent decisions within our portfolios, not just for clients, but hopefully for yourselves as well. And that's a little different than what the general news outlets are going to provide, because they do a really good job of saying, hey, this is what's going on, but they typically don't provide a whole lot of historical context around that. So this is designed to be both fun, educational, as well as practical in the moment in time here. So as that's the little softball toss into what we do here at the Financial Shepherd podcast. And I'm real excited about everything we're getting ready to talk about today.
Yeah, me too. Season 3 begins right now.
Yeah,
and that was possibly the greatest elevator pitch I've ever heard. So I'm sold.
Yeah, no, this is, what they tell you to do in business school, right? You got to have your little elevator pitch ready to go.
Yeah, they tell you that in art school too.
Absolutely. So it works in all kinds of different industries and fields.
Yeah.
Yeah. So we got a lot to talk about today. Anything on your mind, Ez? I mean, you've been a Bitcoin guy for a while. We don't talk a lot about that because it's not something we invest in here. But I'm just curious, man. Like, of all the things that I'm about to talk about today, Bitcoin isn't one of them. But I'm just curious if there's anything on your mind that.
Yeah. Well, Bitcoin seems like lots of other, really in vogue investment opportunities, in that every 6 or 7 months, the world drops out of it and you're going to lose everything you own, even stuff you don't own, which of course never happens.
Unless you're an FTX investor.
Yeah, right. Well, that's not crypto. That was a scam.
Yeah.
And that's the thing, obviously when something becomes, it's like penny stocks, right? Somebody's trying to sell you that stuff, and that's just a complete scam. So crypto, unfortunately, is no different. But no, Bitcoin's good, man. When FTX happened, of course, that had ripple effects, and there was a decrease in value down to about $16,000-$17,000 per Bitcoin. Right. Now we're back up. When I checked it yesterday, before I went to sleep, we were up close to 23 already. Yeah. So back even, closer, it's at higher than it was before that FTX scam. So I think that what's going to happen with something like Bitcoin and maybe even Ethereum, a couple of the other actual currencies that you can use to spend things with, actual investment opportunities, is that we're going to see another slow kind of decrease to some other support level that is just going to scare the world, but then you're going to see a pretty steady increase for the next couple of years, up to something that's even way beyond what it was at the height of the pandemic. So I don't think the main cryptos are going anywhere at this point. They're already, when you can, there are, I don't want to go too far in it because I know we don't talk about it here, and I'm glad we don't, because there's plenty of info about crypto. People can go find. This isn't a crypto show, but it 100%. Is part of my portfolio. It is something that I've enjoyed dollar cost averaging into, and I have still, even when it has been at its lowest in the past couple of years, it's still been something that's in the green for me. So, the technology is very cool. Blockchain, I don't think that's going anywhere. That's going to lead to, I think, a lot of really cool technological advances for the world. Yeah. Not a Bitcoin investor at all, not personally, not for clients. And I can understand why some people might want to stay away from that asset class. Oh, yeah. But for those that have maybe a long time horizon, comfortable risk appetite, because you certainly have to have the right stomach for that investment. I'm looking at it right now. It's still at 23,000 as. Oh, nice. So it's been a wild ride for the markets to start the year in a good way. So that's kind of where I'm transitioning. If you had bought one Bitcoin 3 weeks ago, you'd have made $6,000 already.
Yeah. Well, there's always going to be opportunities.
That's not what I do. I don't want anybody out there to think that I'm like that.
Yeah, right? No doubt. But the reason why I bring that up, right? Because last year, 2022, terrible market year for all asset classes except for the energy sector. Starting out 2023. So again, I kind of have been having a pretty good track record with the data research that we do here, calling for a rally in October. That happened. Best rally for the Dow actually since like the 70s, I think 74.
That's the only reason I keep coming back here. You don't even pay me to do this stuff. So.
Right. November, strong. December would have been awesome had the Fed not basically kicked the market right in the shorts.
Yeah, turned into old man winter and decided to crap on everybody's early spring.
Right. And to start this year, right, Bitcoin's up. We just talked about that. The S&P 500. So let me go through some data points here. S&P 500 year to date up 5%. Awesome. Actually, historically, if the market starts out positive 1.4% or greater during the first 5 trading days, the win ratio, this has happened 7 times, win ratio 100%, the average S&P 500 performance during that period of time is plus 20%. So we're going to talk more about that here in a second.
Nice.
A little teaser. Make sure you guys hang around for the whole
Hit
show
him with
here.
the appetizer, then get in the entree.
Exactly. The Dow Jones, which was the best performer of the big indices, right? Dow's only the 30 companies represent the Dow, so it's not like a really large index.
Yeah.
But typically you got the older companies, strong cash flows, very repeatable business model for decades, right? The Dow was the best performer of all the major indices, being only down 8% last year when the S&P was down 20. Dow Jones is the lagger this year, which is very typical, right? So I'm going to talk a little bit about that today as well. Dow Jones positive 1.6% year to date, not bad, but certainly way behind the S&P. The NASDAQ, worst performing index last year, down 34%, roughly 33%. By the way, the NASDAQ is 25% roughly of the S&P 500, maybe a little bit less than that. Largest sector by a long shot. Healthcare is the second largest sector at almost 14%. So literally tech sector is 2x the next closest sector from a percentage of S&P standpoint. NASDAQ positive 9.6% year to date and climbing, still up here today as we're talking. Again, worst performing sector last year, best performing sector this year. That's very typical. Now, within the NASDAQ, semiconductors, so chip companies, your AMDs, your Intels, your NVIDIAs, Taiwan Semiconductor, on and on. Semiconductor sector, which is in tech, of course, that was down 56% last year. So far this year in 2023, up 15.7%, right? Let's go to bonds real quick. Bonds were terrible last year. The Barclays Aggregate Bond Index, which is the benchmark index for the bond market or bond traders, if you will, which that does exist, by the way. The bond market's almost 3 times the size of the stock market. Most people don't know that. So it's an important part of the market. Bond market was down 17% last year and currently up 2.8%. Why is that? You see things like the 2-year Treasury note, 5-year, 10-year, 30-year, all kind of coming down because they expect the Fed to begin to pause and cut rates here. I'm going to talk about that a lot in just a minute. Now, the Russell 2000, so small caps, not to leave those guys out, important sector, usually does very well after a difficult market year like we had last year. So I'm anticipating that to be a strong performer, up 8.5%. Again, that got crushed last year as well. That was down more than the S&P 500. And international. International is actually doing great, up 7.8%. So if you look ex-US, like developed countries, Europe, etc., up 7.8% to start the year. And we actually started to, again, part of what we do here at Shepherd Wealth Management is based on a modern portfolio theory strategy, which all that really means is that we can control our asset allocation, just a fancy way of saying this is how much we have in stocks, bonds, and cash. The reason why that's important is because Professor Harry Markowitz back in the 50s won an economic Nobel Prize for this idea of modern portfolio theory, and he was able to prove that by controlling your asset allocation, that percentage of money in stocks, bonds, and cash, that actually controls about 94% of the variability of performance over pretty much any period of time you want to look at. And that should be good news to the individual investor because we can sit here, in this office between now and, next Friday talking about all the things that we cannot control ever when it comes to investing. But the one thing we certainly can't control is our asset allocation. And we did not have any international exposure last year, and now we're actually in international at the beginning part of this year for clients, which is a big reason why we do these quarterly reviews. Because stuff changes in the market, interest rates can change, cycles can change with certain sectors, et cetera. And we were out of international last year. It's a good call. Obviously, war didn't anticipate that, but that didn't help the international markets at all. And we were out of fixed income for most customers last year too, just because we knew the interest rates were going up. But we didn't know they were going to go up at the clip that they did. We talked about that a lot last year. So just a really good start to the year, which is why I wanted to kind of tee us up with some of the most volatile asset classes, Bitcoin being up a lot, was terrible last year. Semiconductors were down an awful lot last year, one of the best performers so far this year. So just because something was really a poor performer last year, usually would be a pretty strong probability that thing, that sector or subsector that did so terrible the prior year is probably going to have a different type of result in the future, which is now this year.
Yeah.
And that's kind of the anticipation that we have had all year long. We were dollar cost averaging into tech, right? Taking gains from certain sectors like healthcare, energy, defensive meaning like companies like Lockheed Martin as an example, Berkshire Hathaway, which is extremely well diversified in insurance, et cetera. Taking profits out of things like that and dollar cost averaging into tech, knowing or anticipating that something like this would happen. So the research that we do here is very much fundamental, but it also takes a look at what history has to say. So that's kind of where we're going to be transitioning to here right now. So we got a very, very nice set of data points today.
Love it.
And you know how we like to get into the big data energy stuff here, because data is, the new big, right?
Yeah.
It used to be like, how big of a company can we get to? Like IBM was the largest company back in the 80s in the tech sector for the S&P. And they still exist, but they're definitely not anywhere where they used to be back in the 80s. Right now you got Apple as the top holding the S&P.
Right.
So data is important. Data is the new big.
Data is the new currency, the new power.
100%. And so GDP, gross domestic production here in the United States, up 2.9% versus a 2.8% consensus for economists, which is great. So a lot of strong growth here in the United States coming out of Q4, which was the holiday season. You kind of would anticipate that. But what's interesting to me about that data point is the initial jobless claims. So Fed's trying to basically get people fired. And you see a whole lot of headlines, specifically in tech sector, like all of them, Salesforce, Apple, Amazon, Meta. You pick the Spotify, you pick the tech company, they're laying off people, right? You see it in the news every single day, pretty much.
Oh, yeah.
Initial jobless claims only dropped 6,000, which means less people were taking a jobless claim. So it's a very tight labor market, even though you're seeing all these headline news announcements from tech companies that they're laying off people. Well, certain sectors of this economy, such as teachers, healthcare professionals, they're not, letting people go. They can barely get enough of them. So it's still a very tight labor market. And the Fed's continuously looking at, how tight the labor market is. And they're saying, hey, we don't feel like we can squash inflation unless more people lose their jobs, so we can slow down demand and actually get demand and supply back in equilibrium.
Right.
Well, difficult part about that is the Fed has two mandates. One is maximum employment, and that box is checked. I don't know why they want to mess with that. We're going to talk about that here in a second. I have my opinion as to why that is. Maybe he'll talk about that on February 1st when Jerome Powell gets back in front of everybody at 2:30. So hang on to your hats on February 1st that afternoon. But yeah, the labor market is still great. And the other part of their job is price stability, which is inflation. So we're going to talk about that coming up here in just a second. Now, the markets are saying one thing, and the Fed is still saying something completely different. Now, that initial jobless claims, by the way, it's the lowest that we've seen since April 2022. I don't think that's going to change at all, right? I just don't see that how that difference between the number of job openings that are out there and the number of people in the labor force, still almost a 2-to-1 ratio there.
Yeah.
He can raise rates all he wants to try to get people fired, essentially. It's going to be very difficult for that to happen. You can see that in certain sectors of this economy. I mean, it was so difficult to get people to come back to work from the pandemic to begin with. A lot of it had to do with people getting, checks sent from the government right to their bank account.
Oh, I don't believe that at all. How much money did you get from that?
I got a little bit. I think I got like $130.
So full disclosure, all right, I got
a
laid
month,
off.
something like that.
Yeah, I got my contract non-renewed like in June of that year.
Okay.
And I bet I got the maximum amount of every stimulus money.
Mm-hmm.
And over the course of the entire pandemic, which was what, 2 years?
Yeah, it's called 2 years.
I got maybe $3,500. So you tell me how someone can survive 2 months on $3,500 with the inflation we have, much less 2 years. So of course that's not true.
It's kind of a double dip, right? So for a lot of those people, so I was working, not in this industry. I was working for a small company, selling software. I had 1 year non-compete when I left TD Ameritrade, so I was out of the industry for a little bit. I'm still able to keep my license because I have this 2-year shelf window. So, I was still working, and they were sending me like $130. It had something to do with, we have 2 children, something like that, and we qualified for a very little bit. So I think some people got a double dip, right, where they may have been working at home instead of at an office remotely, and also still getting a little bit of stimulus check, possibly.
Yeah, but again, it's a little bit. And if they were still working, they're not a part of that percentage of people that, quote, didn't want to go back to work.
100%.
Right. But, so like, I don't understand where this kind of logic comes from. It's like, oh, we mailed everybody, and most of that money they printed went to
business.
And CEOs.
Yeah.
So like, it didn't come to the average person who needed a job, who wanted one.
Yeah. And that was a bunch of, debating going on at that time, like all these specifically from the airline industry. Yeah. Like saying, hey, people can't travel. We're going to go bankrupt, basically. So they got a bailout essentially from the government through this PPP program.
Right. None of that is a judgment on my part. No. It's just an analysis, and it really, I don't know. I don't understand.
No. Yeah, I'm with you. I mean, I give them a little grace just because there's no playbook for, a very complex global economy and supply chain just getting shut down overnight for years. And you're trying to prevent a complete economic collapse. You start printing money, right? And sending it to businesses and people and so forth. So I get that, but that's the reason why we had the 40-year high inflation.
Oh, yeah.
And why we paid for it last year.
My issue with it is that it's some kind of reason why there's this issue with a job market. I think that's completely manufactured by people.
I think the actual ratio is a lot closer to 1-to-1. And the reason why I feel that way, if you looked at like LinkedIn data as an example, maybe not everybody posts jobs on LinkedIn, but it seems to be a platform for that specifically, right? Or at least one platform. And I think it's closer to 1-to-1. I think LinkedIn has something close to like 1.5 job openings for every person that's out there. So it's not quite 2-to-1. But we did talk about this in our last podcast that we did a couple weeks ago, which, by the way, you can go to shepherdwm.com, our website. There's a link right on the very top page that'll take you right to YouTube. We can catch all the podcasts that we've ever done, as well as listen to on Spotify if you want to, if you're traveling. So there's been other points in time in history where we've had this quote unquote labor shortage, right? And going back to like the late 60s, 70s, even parts of the 80s and 90s, this was true. And what corporate America did is they automated things. So they made a massive investment into technology. So that's how the tech sector got to 25% of the S&P 500.
Right.
And there's a very high likelihood that we're still going through this quote unquote labor shortage right now. Well, we can't clone people. Immigration law changes. Who knows how long that's going to take, if that ever actually happens. And because of the fact that we are still short people, well, we got to automate this task somehow, either with a piece of software or a robot or something.
Yeah, well, another answer is maybe to raise the minimum wage because, right?
You could do that.
So I don't think, to me, at least in my general sphere, and I'm not the person that you are with finance at all, but there isn't a labor shortage. There's a shortage of people who can afford to survive on $7.25 an hour.
True.
So since there's one job opening for every person, people are now finding jobs that pay them actual living wages. And unfortunately, lots of things like the service industry, retail, all these, jobs that don't afford people enough money to live, they're the ones that are open.
Yeah, no doubt. I mean, it's not, I completely understand all of that, but that's also something that has to get passed, right?
100%.
Takes a long time.
Yeah.
So corporate America is sitting here saying, I'm not going to wait on the government. That's not going to help my situation here when I have quarterly numbers I got to hit every single quarter. So they make a big investment in technology, software, robots, automating things. And that actually makes it more profitable and more productive for this country because once that job has been solved for through automation, it opens up other jobs and tasks that we still need people to do.
Yeah.
It could potentially be, making more money, to your point. Like if it's a simple task, for example, I know when I go to Panera now, I don't necessarily have to go up to the counter anymore. At some Paneras, I can just go to a little kiosk, punch in my thing, not have to wait in line, and then I get a little buzzer that hits me up and let me know my food's ready to go, right? They automated things.
That is super cool, isn't it?
That's going to happen across, it's a simple example, but you can extrapolate that across all kinds of sectors, right? And it's just going to free people up to do other tasks to make it more productive for this country and actually more profitable for corporate America, because if you do automate these simpler tasks, then there's no sick days, there's no health insurance costs, there's none of those issues there. So it's actually more productive as well. So everybody's sitting here looking at the GDP number and freaking out, saying, hey, the Fed's going to have every reason in the world to keep jacking up rates, and he's going to run us right into a wall of a massive recession, which is not actually something that is desired by anybody. And I hope that the Fed doesn't feel that way either. I hope that they don't feel like they need to cause a massive recession by jacking up rates when they can see clearly that there is no more inflation. In fact, we have deflation across many, many sectors at this point. Now, getting back to the data here. So I got off on a small little tangent.
I took us there. It's my fault.
Yeah. So we have money supply growth rate actually negative. So in December, so money supply, let's talk about that real quick for those that don't have a finance or economic degree. Pretty simple. The more money that's out there, the more liquidity that there is in the market. Usually rates are coming down at that point, and it stimulates business investment, right? When rates are super low, there's all kinds of liquidity. There's now a ton of demand to go ahead and make investments into automating things potentially, or to build a factory or a facility, or to hire people, or to invest in technology, et cetera. Rates usually come down during that example. That's exactly the reason why the bond market is positive so far this year, is because rates have come down, at least on the 2-year, 5-year, 10-year, if you take a look at any of those rates, because the anticipation is that the Fed is now going to start to look at either pausing or reducing rates in the coming quarters. Now, they're not going to do that on February 1st. If they do, complete shock to the market, and you'll see just what I would call a face-ripping kind of rally, because nobody's expecting Jerome Powell to come out on Wednesday, February 1st at 2:30 and say, hey, guys, we crushed inflation. It's completely under control, and we feel so confident about it, we'll start to cut rates. Like, that would be awesome.
We're lowering rates to 0.5.
That'd be cool. I don't think that's going to happen. He's going to raise them by 25 basis points. That's baked into the market right now. But the money supply is negative 1.3% versus a year ago. It's the lowest ever. They've been producing, the Fed has been posting the money supply growth rates since 1959. Very cool. And when we transition that to other parts of the world, right? So part of the reason why I wanted to be international has to do with this as well. Bank of Canada, our friends up north, just a cleaner version of America in a lot of respects. Awesome syrup, by the way.
Yeah.
Bank of Canada's first major central bank to signal that it will pause rate hikes. Their Fed chairperson, his name is Tiff.
Good old Tiff.
Tiff says, quote, we are turning the corner on inflation. It's already happening right here in this country as well. We've been talking about this for, I don't know, a couple months now.
2 podcasts ago.
At least a couple podcasts.
Yeah.
Right? We've definitely been talking about interest rates a lot and why the Fed does not need to raise them. In fact, you see deflation across all or a lot of aspects of the economy. Now, the biggest part, or one of the biggest parts of their calculation for inflation, which we're going to get a report tomorrow, by the way. So again, these little inflation reports that we get almost every month or every other month, it's kind of like the Super Bowl for people that work in this industry, right? I'm sitting there 8:30 in the morning. The last time we got a report in December, I think it was December 12th. And I got my computer in front of me and watching the tape. And all of a sudden I get the inflation report that I expected. Lower is good. Market rips up pre-market. So we still have an hour to go before trading is open to everyone. And I have everybody set in my computer screen here because we custody the asset through Charles Schwab, ready to rebalance. I was 100% right until I wasn't, because Jerome Powell came out at 2:30 that same day and said, hey, inflation's coming down. That's nice. 2 straight reports. But, we still look at wage inflation as a problem. And because of that, we need some people to lose their jobs. So we're going to raise some rates some more. And that's why I was right at the beginning of the day, but I was also wrong by the time we got to the afternoon, because the numbers were saying one thing and the Fed, again, is saying something completely different, which makes tomorrow such an anticipated event. I think everybody expects inflation to come in lower than analysts expect.
Yeah.
I think that's the anticipation. I would be 100% shocked if we had a number that came in anything but below what analysts expect. So that would be a very good day for the market in general, except for the fact that on Wednesday the following week, February 1st at 2:30, Fed Chair Jerome Powell is going to come out and say, hey, we're going to raise rates by 25 basis points. I think that is what he's going to do. The question is he going to actually acknowledge the fact that there is now deflation and money supply is negative for the first time in the history of them ever producing the data to the public? That's the major question. And that's the reason why interest rates, even though the Fed is saying they want to raise rates by 75 basis points this year at 3 instances, 25 basis points, per announcement, beginning in February and then again in March and, some other time down the line this year. The bond market's saying you're not going to do it. And you can look at the 2-year Treasury and they'll tell you exactly where the market thinks that rates are going to go. And the Fed's saying, hey, we're going to get above 5 and hold. They think they want to get to like 5.4% on the Fed funds rate, and the market's saying, based on the 2-year Treasury, at 4.15. That's a major difference, right? That's over 100 basis points, or more than 1% difference between where the Fed thinks they need to take rates to bring inflation down, which is a joke. It's already down. The biggest component of inflation calculation is owner's equivalent rent.
Okay.
Why is there such a big lag effect there? Is because if you're a landlord, as an example, well, you're probably only renewing your tenant leases once a year.
Right. Oh, yeah. That makes perfect sense.
Right? It hits the mortgage market immediately. Rates going up, mortgages, 6+%, 7% last year.
It could be even 11 months away before it hits a renter, right?
Yeah, exactly. Exactly right. So rents were going up through the roof throughout 2022. And all those interest rate increases obviously have this lag effect across a lot of sectors. And that data point has one of the biggest lag effects to it. And if you actually look at the data a little bit more closely, you would see that owner's equivalent rent was showing in the last inflation report like positive 0.8%, which is a fairly high number. In reality, it's actually negative. It's like negative 0.3 or something like that. So that's going to actually start to show up in the inflation data, which is why I think most people that follow, the economy as closely as I do, because it's part of my job, they're looking at all this stuff and they can understand why the bond market is saying, there's no real reason to continue to raise rates at all. And that's the fear of the market right now. There is no fear of earnings per share. Like everybody was like, all right, earnings per share is probably going to fall off a cliff in 2023 due to all these interest rate increases. Simply not the case. And that's evidenced by the numbers that we've already received. So we've had 112 companies report earnings so far. That's 22% of the S&P 500. Top line earnings beat, bottom line earnings per share beat, median beat of 6%, and 67% of those that have reported so far have been beating estimates. That's pretty typical.
Yeah.
That's pretty much on par with what we would normally see in a positive S&P, positive Dow, positive NASDAQ type of year. On the top line, so revenue, for those that have reported so far, there's a median beat on revenue of 3%. That's not as much as what we saw last year, and that's just because inflation, right? Jacked up prices, increased revenue. Mm-hmm. That's now coming down, evidenced by deflation across a lot of aspects of the economy. So we're not beating top line by as much, but still 62% of those reporting have beaten top line revenue estimates. So you can't say that earnings per share is the reason why we will have a recession. The real risk of the market is strictly the Federal Reserve. Right? The market is saying one thing, and the Fed continuously says that they're afraid that inflation is going to rear its ugly head again in some way, shape, or form. But these are numbers people.
Yeah.
Right? The Federal Reserve is not a bunch of historian, librarian types of people. They are numbers people. They are, what they say is data dependent, which is arguably not true.
Yeah. That's just a lie.
Otherwise, you wouldn't say that you need to take rates above 5, right?
All right, okay.
If they're truly data dependent, then there's no real reason to say that at all, which is why we have this conundrum here in the markets. And the Fed does not like, by the way, that we have this tight labor market like we've talked about, but they also don't necessarily like the fact that the stock market has performed so well this year. They see it as loosening financial conditions, exacerbating the issue of inflation, which is just simply not showing up in the data. So I don't know what they mean by data dependent anymore.
Yeah.
To me, they're just, finger in the wind kind of guesswork type of stuff here.
Shot in the dark here.
Yeah. Which makes no sense to me. You got 19 people on the Federal Reserve Open Market Committee.
Yeah, who presumably are qualified to be there to handle situations like this should they arise.
What's frustrating about the whole thing is like almost all of them, I think there's maybe 2 people of the 19 that are saying, yeah, maybe we're getting pretty close to where we need to be with rates. But 17 of the 19, they're just straight up saying all the same. They're like, yeah, we need to keep at it. We need to keep raising rates. And that's disconcerting because you would expect a group of people scattered out across the country because they're all in different regions, right?
Right.
They would have maybe a difference of opinion, right? The last time we were looking at the Federal Reserve and everyone was on the same side of the boat, they're all saying the same thing, was when we were coming out of the pandemic and everybody was calling inflation transitory. Like every single one of them were calling it transitory.
Yeah, yeah.
Now they're all saying, well, inflation is going to be sticky because of the very tight labor market and everybody got paid more money because, of inflation, right? Everybody asked for a raise and got it. And those that switched jobs got even, more money. Problem is they are not, the working class American is not the reason for inflation, right? And if inflation peaked at 9 and people only got a raise of maybe 5%, which is what the average was,
yeah,
they didn't cause inflation. They're still behind the 8 ball with inflation.
Yeah, and that's just the average raise, not the average American. Plenty of people didn't get any.
You got all these people at the Fed. They're saying the same thing. We got to raise rates. That just tells me that they're wrong. And the bond market, again, is not just looking at the data, but they're also looking at the history of the Fed. So we talked about this in a prior podcast. I'll briefly mention it again. You go to December 2021, Fed announces what they think they're going to do with rates in 2022. Everybody knew that we're going to go up. And the Fed said so much. We're going to raise rates, but we're only going to do it by 1%. We're going to do 25 basis points 4 times. We'll end up doing 450 basis points. They did 400 of that in 6 months. So they were all wrong then, and they're all wrong now. And the stock market and the bond market is calling the Fed's bluff. Somebody's going to have to blink here. Because if we look at 2024, which is going to be a election year, right?
Oh, history isn't it?
History would say the third year of a presidency is generally their best year from a stock market performance standpoint. So that's in our favor, among a whole bunch of other things. You got the VIX below 20. Another data point here that I think is fascinating. The VIX, which is a volatility index on the S&P 500,
right? It
averaged 25 last year, which is high. When the VIX is below 20, the average gain in the S&P 500 is plus 20%. So there's a whole bunch of historical reasons why this is going to be a double-digit performing type of year. And the only concern, the only thing that can mess that up, unless corporate America somehow just, I don't know, completely jacks their own situation up, right? Which I don't even know how they could do that because earnings have been so good and labor market's so good. The only thing that can screw this whole thing up is the Federal Reserve continuously, for no real specific reason, feel hell-bent on raising rates just to make sure that inflation is completely flattened out. And they keep pointing to the labor market as a big reason why they can continue to increase rates. When the data is suggesting that, inflation, it really isn't inflation anymore. It's truly deflation. You're seeing it everywhere. You're seeing it at the grocery store. You're seeing it at the pump. You're seeing it everywhere. Question is, when is the Fed going to actually acknowledge that with their own words and actions? So if they want to keep raising rates, I can assure you that we will have a very severe recession. A whole bunch of people will lose their jobs. And again, I guarantee you, the very next quarter or whenever the Fed makes an announcement, should that happen, they'll say, I think it's time to start cutting rates.
Yeah, right.
Right? And then all these people that have got laid off are going to get hired again, either at their previous job or someplace else. And we play this stupid cycle.
Right. It's like getting out of a giant car wreck after you slam into a brick wall, being like, hey, you should buckle up.
Yeah, appreciate that.
Yeah, thanks.
It's a good way to look at
it.
But what does a soft landing look like? And I think we'll try to get some questions in here as well. So what does a soft landing look like? It's where you keep maximum employment,
right? Check.
And you have price stability, getting back on track to that 2% long-term, inflation target that the Fed has. Mm-hmm. Well, based on
the way,
if we get tomorrow's print, so 8:30 tomorrow, if we get inflation coming in like it did in December and November of last year,
yeah.
If you annualize that, you're getting very close to that 2% number. You're probably going to be somewhere in the 2.8 to 3 range. I mean, you're right there. You're right there.
That's enough to trust the lag effect to continue that 0.8% and just at least pause.
Right.
And maybe not cut.
Exactly. That's the point. That is what a soft landing definition is. Like literally they could claim victory, look like heroes, write books, maybe do a documentary on Netflix, years down the line.
Bush was on that aircraft carrier? We're talking like this times that times 20.
Yeah. Everybody liked The Last Dance.
Oh, yeah.
The Fed could have like a 10-part documentary of, hey, this is when we screwed everything up, and this is the moment in time where we recognized that, owned up to it, and did something about it. Like that would be a cool story. You can humble up a little bit.
Right.
Instead of worrying about their reputation is really what is the main reason why I think that they're still screwing around with rates and talking, like these bunch of tough guys and gals that are going to save America from 40-year high inflation that you guys freaking caused yourself.
Yeah.
Yeah, so that's their interpretation of how people perceive them is they will lose credibility if they don't damn sure make sure that there is no inflation anywhere in sight.
But they already have lost credibility. That's
100%
what I don't get.
lost.
It's like
they lost it when they said it was transitory and they were only going to raise rates by 1% in 2022. Way wrong. And guess what? The bond market called their bluff in January of 2022. Fed says they're going to raise rates by 1%, which is 100 basis points. The 2-year was already there.
Yeah.
In January. 2-year was like, dude, what are you guys doing? What are you waiting on? And then 2-year was right again, right before the Fed jacked up rates 75 basis points for the first time in June. So history would say that the Fed got it wrong then. They have it wrong now. And the VIX is lining up the right way. The bond market is acting the right way. The data is suggesting what they've already done with rates has worked and is continuously working with the lag effect like we've talked about. Money supply decreasing. They have it all laid out in front of them to declare victory on inflation, which would, again, is a big reason why I expect the markets to be double-digit performers type of year. And the biggest sectors that are going to benefit from that were the ones that got hit the hardest last year, technology and then subsectors of technology. I rest my case that we will have an excellent performing year.
We got to get you a gavel, man.
But that's how I see it. That's how a lot of other people see it. But the Fed is saying one thing and the market's saying something else. And there's a lot of people, a lot of smart people in the market, professional investors, people that manage money for a living, private endowments, all this stuff. And they're kind of divided because of what the Fed's saying and, again, what the market's actually doing and what the actual corporate America numbers are looking like. Tesla, again, a phenomenal quarter. I don't own Tesla for clients. I don't own it personally. It's more of a fundamental reason as opposed to, is a product cool and all that sort of stuff.
Yeah.
Awesome quarter. Stocks up big today. Sherwin-Williams, it is a position that we own. It's a paint, obviously it's a paint company. They have a very high market share. Like they dominate their sector. And if you look at a 30-year chart on Sherwin-Williams, tell me that's not a stock that you want to own. It's basically outperformed the market for decades.
Dude, that's one of those umbrella stocks, not to get off topic, that you don't realize how many other brands are owned by Sherwin-Williams. It's like a Nestle or something.
Yeah.
I'm not saying go buy Nestle. I'm just saying.
It's like a perfect Warren Buffett type of company.
Yeah, 100%.
Right. It's a big reason why I love it. Nice dividend too. They actually produced really good earnings. Stock's down like 8% right now just because the CEO is saying, hey, we can't really foresee how the economy is going to look into the future here this year because of all the interest rate increases that we've seen.
Oh my gosh, honesty.
Yeah. And we understand that that's going to have an impact on our business to some degree. And they may have to let, some staff go as a result of that. But they still are in a position to continue to grow as a business long term. So I'm going to continue to hold the shares. There's nothing fundamentally wrong with it. Again, they had really good earnings. They beat analysts' expectations. But because of that forward guidance being negative, stock's off 7%.
Right.
Now, same thing happened with Microsoft, by the way, 2 days ago. Microsoft beat top and bottom line, crushed it. All they said, or the CFO said that, hey, we expect probably a pretty good year, 2023. We're going to have to let some people go along the way. And we'll probably lose 1 to 3% revenue growth from their cloud part of their business, Azure, which has been on fire. So that small anticipation of lower demand for cloud is no reason for me to sell Microsoft at all. But the stock was down, last I saw, like 5, 6, 7%, even though they crushed top bottom line. So again, the CEOs are basically lowering the bar for themselves for future quarters when they have their quarterly announcements, which I would do the exact same thing because they don't know for sure what the hell the Fed is going to do with rates and whether or not they're going to run the country into a massive recession for no flipping reason. Like, they don't know. This is why you have this weird situation that we're in here from a market standpoint. Even though we're up pretty nicely to start the year, it really hasn't substantially broken out yet like you would anticipate it would. Like when you're hearing 40-year high inflation all year long, every single day, for all 2022, and you have 2 consecutive quarters of negative GDP, all of that plus a double-digit decline in the S&P of more than 20%, all that is textbook definition recession. It checked all the boxes except for unemployment. Unemployment never got even close to 4%. Yeah, so basically, I can understand the concern that CEOs have, and I can also understand the concern that other market participants have. Like, I have clients that are saying, we're going to go into a recession. Maybe, but I actually would argue that we already went through the recession in 2022, and the only reason that we would have a recession this year is that the Fed flat out just causes it for no other reason than to, in their opinion,
squash inflation
and probably protect their reputation because they said they were going to kill inflation. They've already killed it, guys. I mean, right now they're just shooting a dead animal that's already dead. Like it's dead, right? You can't make it more dead.
No.
No. So it doesn't make sense to me. So I expect that the market has this right, and I've positioned clients accordingly. So as we've dollar cost averaged into tech last year, as tech grows, like it already has this year, pretty soon we're going to start to rebalance a little bit out of tech and move into other parts of their portfolio. International industrials, right? Industrials, about 9% of the S&P 500 should do well coming out of what I view as a recession in 2022. Not just for that reason, but for the simple reason that the Federal Reserve or the United States government has already passed the CHIPS Act. They've passed infrastructure bills. All that money is being spent over the next 10 years. All that means that we need to move ground, we need to build things, et cetera, and that is going to benefit that specific sector. And of course, one of the best performing sectors last year was healthcare. Healthcare has been one of the worst performing sectors so far this year. Still a little overweight that for clients, just because I still have a small concern that the Fed's just going to be hell-bent on raising rates above 5 because that's what they said they were going to do, damn it, and we're just going to get there.
We found bed bugs in this hotel. By the way, I brought them here, but that's beside the point. But I'm going to light this hotel on fire just to make sure those bed bugs are gone.
Right. So, I mean, that's really where we're in right now. This is the dichotomy. Market's saying one thing, Fed's saying something completely different, and it's causing a lot of confusion. And I can understand why, but the data is telling me that the Fed does not need to do anywhere close to the type of damage that they're talking about doing with raising rates. And if I'm right, and the market's right, which is where we stand right now, you're talking about a double-digit performing type of year. And it's going to be led by tech. It's going to be awesome.
Love me some tech.
I can't wait to have a quarterly review for the first time. And I basically started this firm at the peak of the market.
Yeah, you did.
And
However, you won't brag about it, but I will. Didn't lose a single client.
Didn't lose a client, and the reason for that is because we provide the historical context. And it didn't hurt that I was right in the latter part of last year. I wish I would have foreseen, what the Fed was going to do. I should have been paying more attention to the 2-year, in 2022. But that's a little bit of a lesson learned. However, again, if we're right, we're talking about double-digit performing types of years, and all the rebalancing that we did certainly would benefit all of the clients from that. But, and the last thing here, from a data standpoint, that's a tailwind for the stock market. You got the U.S. dollar. It was up 22% last year. I think that it's down, double digits already this year. Dollar's coming down, which is really good for international companies, right? Performance was really good there. It's also really good for U.S. Domestic companies that sell products and services internationally.
Yeah.
So it should be a nice little 8% tailwind to their earnings, which is, again, why I don't see earnings being the problem. And even if earnings were to be negative, so this is a really cool data point here. If EPS growth, earnings per share growth, is negative year over year, which a lot of people are saying is likely, the median gain in the S&P 500 is almost 15%.
Wow.
Now, if earnings per share growth is positive year over year, which is unlikely, median gain in the S&P is 15.5%. So that's a pretty negligible difference, whether or not earnings per share is positive or negative year over year. What the big impact is the VIX. Like I talked about earlier, if the VIX, the volatility index, which is just a bunch of 30-day options contracts on the S&P 500. So some people will be bullish or bearish depending on the option contract. If the VIX falls sub 20, you're talking about a median average gain of 22% in the S&P 500. That happens 83% of the time when the VIX is that low. So I would argue that the VIX is going to be the more better indicator of the performance of the market. And earnings per share, I think it's going to come in just fine. It's not going to fall off a cliff like a lot of people think, but history would say that doesn't actually mean a whole lot coming out of a down year like we did in 2022. And last data point here is if we go from World War II to now, there's only been 3 instances over that period of time where we've had back-to-back negative performing years in the major averages. So all this is lining up for double-digit year, folks. You heard it from me first, I hope. And it's time to get back on the risk-on, bullish equities, technology. Expect that to be the best performer. And for all the regulators watching, past performance is no guarantee of future results. So there you have it. It's not a guarantee. But the one thing that we do know, thanks to Warren Buffett, about human beings is that we have not learned from history at all.
Oh, God, no.
2,000 plus years of being on this planet. And I think most people would agree that we haven't changed a whole hell of a lot.
Well, here's to bucking that trend, all right?
Yeah, so we'll see what happens. But yeah, it's been a strong year to start out 2023. Economy is extremely resilient. And the data, if you are a data-dependent person, which I am, I mean, I don't know how the hell I can go into a quarterly review with a client without actually backing up all the decisions that we made with hard facts and historical evidence. But, here's to the Fed, hopefully looking at the data this time.
I think that we might have another year just YOLO.
Yeah. I'm off the YOLO train, man. Yeah, that's for sure. But the Fed's going to have the inflation report like we all will tomorrow at 8:30. Very, very excited about that. Expect that to be lower, which is good. And I think the annualized trend of that is going to basically tell everyone that inflation is no longer the actual problem here. It's the Fed actually acknowledging for the first time that what they've done is, in fact, working and working very, very well, and there's no real reason to continue to do that. And that's the exciting part for next Wednesday. So February 1st, 2:30, after we get the inflation report tomorrow at 8:30, is the very first time we'll hear Jerome Powell speak about the economy as it stands and what they expect to do with rates. Expected 25 basis point increase that day, but more importantly, what is his outlook in the future, coming months and quarters as it relates to inflation and what they want to do with interest rates. So with that, got a lot to look forward to this year. I think performance is going to be outstanding, and I'm going to be here the whole time. So if you have questions about what's going on, not just in the economy or what the Fed's doing, but your own portfolio, how you're positioned, how you might want to consider rebalancing things, hit us up, 513-630-2664. Again, you can go to our website, shepherdwm.com. There's a whole bunch of background information about myself, our firm, what we're all about, what we stand for. And of course, there's a bunch of links that'll take you right to our YouTube page as well as Spotify, so you can check out all the podcasts that we do. And lastly, tomorrow is Friday. It's Happy Hour Friday around 4:15, right as the market closes. Check us out on YouTube Live, where I'm going to be basically wrapping up what happened in the markets this week and what maybe history has to say about what actually happened, specifically with the inflation report that we're going to get tomorrow morning at 8:30. And then, of course, bring your favorite beverage of choice while you join us on YouTube Live. LaCroix.
Love it.
Teas.
Love it.
You got a beer, bourbon, whatever. It's
Double
Happy Hour Friday. So I'll be here. We'll be posting that. And we'll try to do that every single Friday. We're not perfect on that.
No.
Sometimes you're traveling. Sometimes you just don't really need to do one because nothing really happened that week. But we will try to do that as often as possible every Friday. So hope you guys enjoyed the show. We'll be back again in a couple weeks with a bunch more of exciting announcements. Should have a guest here with us as well, potentially. So stick around for that. And I hope you guys have a great rest of your day.